Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Bob Elliott. How you doing today, Bob?
Hey, how's it going?
Good, good. Glad to have you in the show. This will be a fun conversation, given what's going on in the world. So, Bob, maybe you could tell us a bit about your background.
Sure. I mean, I've been a systematic macro investor for about 20 years. I was on the investment committee at Bridgewater Associates, which was the world's largest hedge fund at the time, and created investment strategies across all the major asset classes. And since leaving Bridgewater a few years ago, decided to work on trying to figure out how to bring diversified, low-cost 2 and 20 strategies to the everyday investor. In the same way, stock and bond indexing has totally changed investing in those assets. What we're looking to do is bring the same sort of concepts to 2 and 20. We started off with hedge fund indexing and are working to build a wide range of products.
Okay, so what is 2 and 20 for the average listener who doesn't know?
Yeah. I mean, 2 and 20. I mean, 2 and 20 is a compensation scheme, which means that it's 2% of assets under management and 20% of profits. And that compensation scheme is common across a wide range of different, what are generally described as alternative assets. So assets like hedge fund strategies, private equity, venture capital, private credit, et cetera. And the challenge with those strategies is that 2 and 20 can mean anywhere between 400 and 800 basis points of fees, 4 to 8% of fees for unexpected performance. And when you have so many fees, it's very hard for those managers to do much better than the investor could do on their own. The manager does well, and those strategies are great for the managers, but they're not that great for the everyday investor. And so our focus, in the same way, it used to be have to pay 100 or 200 basis points to go into stock mutual funds, and now you can do it basically for free. We're trying to bring low cost indexing to the world of 2 and 20.
So why would anybody be interested in 2 and 20 when they could just pay 5 basis points for an index?
Well, the strategies are pretty good, and the challenge is that they're too expensive. So if you take something like hedge fund strategies, in general, if you look over time, the strategies before the fees uh, generate returns that are better than stocks with half the monthly volatility and a third of the drawdowns. That's a pretty good return profile for most investors, and there's a reason why a lot of institutional investors find those strategies to be compelling, because the frank reality is most institutional investors can get into those strategies at much lower fee points. And so our idea is build products that seek to replicate essentially that return stream, that return opportunity, but do it at a much lower fee point, which makes it a more compelling opportunity for the everyday investor.
Okay, so basically what you're saying is that it's the risk management that is what makes it better. It's not necessarily the performance, but more the management of risk, correct?
Well, the headline performance is that's exactly right. Is equivalent or just slightly better than what you could get in the S&P 500. I mean, to be clear, most people, their risk target is not, their return target isn't just the S&P 500, right? It's less, a traditional 60/40 investor is considerably lower than that. So you're getting stock-like returns designed with lower risk and lower correlation to the equity market than investing in stocks alone. So and ultimately, because investors don't necessarily know when they need their savings capital, reducing risk without necessarily giving up too much on the return side is quite compelling in terms of building that durable savings portfolio that compounds over time.
So, I mean, hedge funds is such a broad category. How do you differentiate? I mean, there's so many different types of hedge fund. So how do you kind of differentiate between them and what does well and what doesn't?
Yeah, I mean, you're right. There's lots of different strategies that are out there. Unfortunately, my co-founder and I, between the two of us, we basically built proprietary strategies in all the different approaches of hedge funds through time and in the course of our careers. And so, uh, basically what we do is we create replications of each individual main strategy. So equity long short strategies are different in terms of how they're pursued than, say, global macros versus fixed income strategies versus emerging market strategies. And we create replication. We build technology that creates replication of each one of those major hedge fund styles, is what we like to call them. And then we combine them together to create an index fund in the same way you might combine, a set of stock sectors to create an overall stock market index fund. We're creating different replications of different hedge fund strategies individually and then combining those together into one product. The advantage of which is, instead of when you invest in a single manager, that manager might do well, it might do poorly at any particular point in time. But it's quite idiosyncratic when you start to index hedge fund style, hedge fund strategies. You get better diversification, which allows for you should expect to have a more consistent return over time, and that's what we've seen in the past as well.
So what are some different, just for listeners' reference, what are some different hedge fund styles as an example?
Yeah, I mean, the most common that many people I'm sure are familiar with is equity long short, right? Which is basically managers that are taking bets on certain stock sectors or factors or individual stocks, maybe relative to their sector or the market. They'll also trade different indices globally, all around the basic concept of, there's a universe of equity market assets that are out there, and going long and short them, you can create stock-like returns, but reduce the volatility that you typically have if you just invested directly in, an index investment like the S&P 500 or something like that. That sort of contrasts with something like, say, global macro, which is quite different. A global macro manager would be betting on the price trends across major asset markets. So that's not just in stocks, although stocks are a portion of their portfolio. It would be things like what's happening to monetary policy or bond yields or currencies, commodities, credit instruments, things like that. So a much different universe, broader universe. And again, what they're trying to create there with that universe is they're trying to create a better risk return profile than, for instance, just investing in like a 60-40 portfolio.
So how do you replicate a global macro style? Because isn't that more individualized based on the manager's perspective of what's going on globally?
Yeah, I mean, that sort of goes to the core of our technology and our approach, which is really starts with the intuition that I think a lot of people who look at any asset manager's returns have, which is if you know the asset manager's returns in a period and you know basically what their strategy is in terms of their opportunity set, you can infer what's going on with their positioning. So look at an equity manager and you kind of know, like, based on their returns, were they overweight tech or underweight tech or overweight Mag 7 or underweight Mag 7, et cetera. And what we do is we basically do the same thing, except in a, essentially a more sophisticated way driven by machine learning, some modern machine learning approaches where we look at the pattern, we look at the returns that managers are delivering. We know the sort of strategies that they're pursuing in their opportunity set, and we can back out probabilistically what portfolio they're holding that's generating those returns in pretty close to real time. We get pretty close to real time performance information, so we can understand how they're positioned in pretty close to real time. And so it's that inference backing out how they're generating the returns that they are that we can use to then replicate how they're positioned, using long and short positions in liquid securities, and can package that into structures that make it, available to every investor rather than just to, very wealthy accredited investors.
So how do you get, I mean, aren't most of these managers producing their positions quarterly? How are you getting close to real-time data on them?
Yeah, well, we look at the returns, and there's performance aggregation companies that bring together return information on, some of it a daily basis, and the sort of best in class stuff monthly, a few days into the subsequent month. So we have pretty good real time understanding, and we often are looking at this not at one individual manager, because there's a lot of idiosyncrasy in one individual manager, but sort of the index of that hedge fund strategy style. So what are the 500 global macro managers? How are they positioned in aggregate? Or the 1,000 equity long short hedge funds. And that's really where there's signal. Any one manager, they could be long, they could be short this asset, that asset. The real signal comes from the wisdom of the crowd, of the smartest alpha managers that are out there, and that's really what we focus on. And that stuff, as I said, is available very close to real time when it comes to return information.
Nice. So let's talk about global macro. Just for the listeners' sake, because obviously that's a broad category and everyone's got opinions. What are your thoughts on global macro right now?
Well, I think for many investors, this cycle has felt pretty unusual because there was a lot of expectation that we were going to move pretty swiftly into recession as a function of the Fed shifting to tightening, traditional indicators like yield curve inversion or leading economic indicators creating a slowdown. But I think that that set of thoughts hasn't come to fruition, in part because the cycle that we're having today is pretty different from the cycles that we've had traditionally during our professional careers, which is we've typically had credit-driven cycles. Whether you look at '08 or the 2000 cycle, which was a business credit primarily oriented cycle, or before that, which is pretty different than the cycle we're having right now. Right now, credit growth in the US economy, whether it's for businesses or for households, is at recession level lows. So it's not credit growth that's driving this economy. What's driving this economy is income growth. And that income driven expansion, it's just very durable relative to typical credit driven expansions because it doesn't build up the sort of excesses that would emerge in a credit driven expansion. And so the economy has been much more durable to rising interest rates than many people expected. I think the challenge is in terms, and that's really, the economy is like outperformed for the last 8 quarters relative to consistent expectations of recession ahead. I think the challenge is right now is that continued strength is decaying over time because interest rates have some effect, just not as big an effect. So it's decaying over time. We see that in things like employment data and demand data and things like that. At the same time, people are sort of extrapolating great growth in the US to continue essentially forever, with earnings growth in stocks expected to be, 18% by year end of 2024, and then another 15% in 2025. Those are very high earnings growth expectations for an economy growing at 5 or 6% a year nominal GDP growth and slowing. And so that's kind of the, after 2 years of everyone being too bearish on the economy, now it looks like people are too bullish on the economy. And that's, raises questions about whether the equity bull market has the ability to persist.
So it kind of brings up a good question. I mean, people were bearish, now everybody's bullish. Like, what is going to, if this is a different type of cycle, what do you think is going to cause the next recession? Because I mean, there's still a lot of factors that don't make sense, like housing. Doesn't make sense why it is where it is. I'm just curious your thoughts.
Yeah, I mean, housing in particular, what we've had is, there's essentially secular forces that are, related to the fact that we've underinvested in housing for the 15 years post GFC. And so that's created a circumstance where there just is not enough housing supply relative to household formation. And so that, that sort of secular dynamic can persist longer than the tactical dynamic, combined with the fact that asset prices have gone up, which means people can actually pay more for houses, essentially in cash or bigger down payments. So housing hasn't been a very good indicator. I think the way typical, let's say these sort of typical income driven expansions eventually sour, if you go back and look at the sort of 50s and 60s, which is when this was more common, is, higher interest rates slowly but surely take the wind out of the sails of the economy, and you have a gradual moderation. And that often coincides with this sort of moment where expectations are very high with a gradually slowing economy. And that when you get that disappointment relative to expectations, so everyone thinks that, earnings growth is going to be, 15% for the next couple of years. Let's say earnings growth comes in at 5%. That's not bad by any stretch of the imagination. It's just not as good as people were expecting and pricing into assets. And so what happens is that slowing economy underperforms high expectations, which hurts asset prices, which then starts to create shifts in demand, meaning people save more relative to spend more or are more pessimistic, which causes them to slow their demand and create the reinforcing weakness in the economy. And that's how these cycles typically end. It's not an acute moment. There's not a credit crisis. It's not like Lehman fails and then the economy goes off a cliff. It's more like the economy simply disappoints, and that sows the seeds for the downturn dynamic that can come ahead.
Yeah, I mean it's interesting. I mean, obviously, I only live in a certain part of the world, so it's hard to see everyone else. But to me, when you have a a big jump in interest rates, not just from a big jump, but also from expectations. People expect 0% interest rates, and now they have 5% on treasuries, and certainly got 30% on their credit card interest rate. Um, you know, uh, the thing that I'm challenged to try to figure out is, you go from pretty much whatever it was, 10%, 6 to 10% in credit cards. Now it's up to 30. Now, you've got real estate that basically the payments, monthly payments of real estate double, which means you can afford half the house you could have afforded before. I don't care what the supply and demand is. If you can't afford to buy a house, you can't afford to buy a house, right? So what I'm trying to figure out is people talk about the supply and demand is all that's great, but people aren't running around in caravans looking for housing. Like people have to live somewhere. So how is that impacting the real estate market? On top of that, you've got the consumer that can't afford to pay for all the things they used to pay for because of credit card debt and because basically everything's more expensive. So how does all that play into the global macro vision?
Well, I think on the housing side of things, I think the challenge is the supply demand dynamics that drive the price in a housing market that is in a boom is very different than a housing market that's in an activity bust. And the US housing market is in an activity bust, no matter how you describe it. And so what's happened is uh, essentially because of that, the amount of demand for housing has fallen a lot, right? 50, 60% in terms of overall demand. And we're actually a little weaker in terms of demand than would be implied by like natural rates of movement. Like, people have kids, they need a house, people get married, they get divorced, they die, like all that stuff. There's reasons why, like there's some level, a baseline level of housing. The actual demand has been even weaker than that baseline level of housing demand in the last couple of years. And the challenge is that the desire to supply into the market is just so much lower because so many people post COVID locked in, 3% mortgage rates. And so the desire to move and give up their housing is so incredibly low that it just happens to be even weaker than what is demanded right now. And so the way that gets resolved is one of two ways. One, you get an increase in building, which is essentially what we've seen, which is kind of funny because what that is it creates a positive GDP effect, which is a little counterintuitive. The housing market's in terrible shape, but there's a positive GDP effect because houses are being built. That's certainly part of the supply story. And then the other story is eventually you exhaust the people who can buy at the higher dollar value rate. People who, there's a flow of people who can buy at this rate, and eventually you get to a point where no one else can buy. And when you get to that point, that's when you start to see housing prices teeter over. And so I think it doesn't look like we're that far from that sort of exhausting the, to be blunt, like the rich people's demand or the millennials who are getting support from their parents. Like there is a limit to that amount of demand, and we're getting to exhaust that limit. It's been in place for 24, 36 months, but it won't be in place for forever at this level of prices. And that will really create the tip over of the market.
Yeah, interesting. No, I appreciate that perspective. So what should people be looking at right now? Because what you're talking about, I mean, we've got the stock market, which is interesting, right? You got a handful of companies that are doing well this year, and you got everything else that's underperforming, let's just say the market. Um, and there's a lot of overall, PEs are expensive. Um, what from what you're saying from a macro perspective, it makes a lot of sense. But how does that translate to the stock market when what's basically required is really excessive growth, from a lot of these companies, which obviously, doesn't go on forever. So,
Right.
how does this play out? I guess how far are we from that transition that you're talking about of, starting to slow down and expectations? Because I feel like we're kind of getting some of that, but it's hard to tell on a small scale.
Yeah, I think there's sort of two things. If you're thinking about, if you're a saver, right, building a long-term savings portfolio, like it's incredibly important to recognize that um, yield is destiny when it comes to returns, particularly in the medium term. And what that means is if you're paying a lot in price terms for an asset and getting not much yield, your return in the future is going to be weak. It's going to be set by the yield you're getting. And when I look across basically all assets today have bad yields, all risky assets have bad yields relative to cash. So like, the stock market, the amount of yield you get on the equity market relative to risk-free bonds is basically as low as it's been since the 2000s bubble or 1970 or 1929. Those were not good times to be buying stocks in the past. And so, so equities have pretty poor yield. When you look at corporate spreads, various spreads in the economy, those are also at all-time lows. The last time we were there was 2007, and we know how that played out after 2007. And then also just the yield that you get holding, even if you just say, look, I'm not going to hold risky assets, I'm going to hold, bonds relative to holding cash. That also gives you a pretty terrible yield. Bonds, short-term cash is yielding 5.5, and bonds are yielding 4.25. Right? That's a pretty bad return dynamic that you're seeing. And so you look across all these assets, and you're basically like, all of it looks like pretty bad yield in the medium term. So if your savings portfolio, your savings perspective is like a 5 or 10 year time horizon, this is not the time to be going YOLO stocks. This is the time to be taking advantage of the elevated prices across all financial assets and stepping back and reducing your risk and putting yourself in a better position for the bumpy ride ahead. Now, when that bumpy ride comes, look, that's very hard to determine. I think we're transitioning to that direction because we have a combination of long-term overvaluation, but also short-term very, very high expectations that sort of come in, will likely come in, reality will come in below those expectations. And that's the sort of dynamic that creates a turn in the economy. Is that this month or next month or the next month? No one really knows at that level. But, it's probably not going to be 2 years of this, continued euphoria that we're seeing in equity markets.
Yeah, I mean, it brings up this question of the 1970s, right? The late 60s, early 80s, but that period of time, which was very interesting on so many levels, and it feels like there's a lot of similarities to the 70s. Certainly a lot more so than it was the early 2000s, which had a similar kind of long stretch of sideways movement with a lot of volatility in between. Um, and so I'm wondering how does that are there similarities there that we can learn from and as a side note, one of the interesting things about the 70s was there was a lot of confusion. Like people didn't really know what was going on, right? Like it was
Yeah.
even stagflation, they didn't know what that was until much, much later, and then they coined a term for it. So there's a lot of confusion as to what was happening, which to me seems very similar to now as well. So can you kind of talk about that period and what do you see? Can we learn from that period or what can we take away from that?
I think those periods are helpful because they are challenges to the sort of status quo view of how asset markets will perform. Like we've had since that point, since the early '80s, we've had basically 40 years of disinflationary strong growth, and so many savings portfolios are built on the expectation that that will continue forever. Um, and, in a lot of ways, there were a lot of one-off factors that drove that 40-year period that are unlikely to persist in the future. We went from not being globally integrated to being much more globally integrated. China went from having, 700 million people on the farm to now putting 700 million people in the factory. Like, we went from a Cold War period to a peace period for an extended period of time. We went from the U.S. Being part of a bipolar world to being, the hegemon. Basically, you look at all those things; those are all reversing, right? De-globalization is happening. The U.S. is no longer the hegemon. We're not in a position. If anything, we're moving towards a dynamic that looks a little more inflationary and a little more conflict oriented, rather than high productivity and peace, the way that we've experienced. And so, what that highlights, and it's exactly what the '70s highlighted, is no one walked into the '70s and said, "Oh, I realize that there's going to be significant inflation, therefore I need to buy, gold and commodities and things like that." These things naturally sneak up on investors. So unless you're managing your everyday portfolio and carefully examining what the probabilities are, it's much better to build a diversified portfolio that's not essentially all in on one particular bet, the way sort of 60/40 is. Build that diversified portfolio. So assets like gold and commodities, those are assets that most people don't have in their portfolio, which would be very beneficial if we end up getting a scenario that looks closer to the '70s. I don't think we're going to get the '70s, but closer to the '70s dynamic.
Yeah, I know, I agree. I don't think we'll repeat the '70s, but there's certainly a lot of similarities. So it brings up the another few questions, which is when it comes to interest rates, the market has been very, very wrong so far for the last few years. They were wrong up until, I guess they were right on January 2nd of 2022. But why they didn't do anything prior to that is beyond me. And then obviously everything was bad in that year. But so far this year, I think it was going into December, they were predicting 8 or 9 rate drops, and which I thought was a little extreme. And now they're back to, I mean, we thought that they wouldn't drop it them all, but maybe one. But now they're kind of back to more realistic expectations of, well, maybe they're not going to drop it. But why? The big question I have in my mind is not them being wrong, because they're frequently wrong, but why hasn't the market aligned with missed expectations, right? Because frequently when expectations are such, the market is priced according to those expectations. But when those expectations change, typically it reshuffles the market to different prices, but that hasn't happened. So why do you think that is? And what is kind of going on that is keeping the market so buoyant when expectations of interest rates should be a big impact on future returns?
Well, I think in a lot of ways, what we've seen over the course of the last couple of years is high volatility in expectations and low volatility in shifts of reality. And part of that is, if you go back sort of post global financial crisis, a lot of the people who are sort of trading and investing today, who are on the desks making the calls, they learned a lot during the global financial crisis, which was to follow the trend. And if you saw any indications of trend reversing, then you immediately wanted to jump in and assume that that was going to continue. But the fundamental reason why that happened was because the Fed was driving asset prices either up or down based upon their liquidity provision. Versus today, the Fed's impact is much more de minimis because the economy is less credit sensitive, and less, more sort of driven by income growth, which is more durable, as I described before, and less driven by credit or by the Fed's undulations, right? And so what happens is, we've had people whip around their expectations significantly, whether back in SVB, they said interest rates were, markets priced interest rates in the low threes to come right after SVB by the end of 2024. Interest rates will not be in the low threes by the end of 2024, right? Like not even close, right? And then, they price for big rate hikes and then cuts and then hikes. And so all of this movement is because people are looking at incremental pieces of information, trying to say, oh, this is the turning point, this is the turning point, this is the turning point. But the reality is, in a slow moving late cycle dynamic, there is not a turning point. There's not an acute moment where the cycle falls apart and we move in a different direction. It's just a slow, steady grind weaker. And so you've actually been in a lot better shape fading extreme expectations over the course of the last couple of years, rather than trying to say that that's going to be the turn that makes it. It was not that long ago, as you mentioned, 7 cuts were priced in to start the year. People were buying, meaning they were going long bonds with 7 cuts priced in for the year, meaning they thought that there might be 8, 9, 10, 11, 12 cuts for the year, right? That's what they were pricing in, equivalent cuts for the year. And that was just so desperately wrong relative to how fast the economy has been moving. That it's just important to have a little bit of humility to recognize how that sort of incremental information that everyone's focusing on can be so wrong so often.
Well, I agree with that. It's very, very wrong very often from what I've seen. But let me ask you this. I mean, you just said the Fed's impact is obviously a lot less powerful now. Um, my guess is they would try to reclaim that power at some level because otherwise, why do we need them? Right? Like, what? I hate to be so obvious, but um, does the Fed even need to change rates? Like, why not just leave them where they are? Like, why make any changes at all? Things are humming along just fine.
I think people often forget that, like, the sort of natural state of a central bank is inertia and doing nothing. That's the natural state of a central bank. And the reason why that is, there's sort of institutional reasons why that is, which is they're very consensus making, or consensus driven entities, which means, like, you have to bring along the biggest outsider in order to change policy, and they're backward looking in terms of what the data is that they're looking at. And what that means functionally is, unless there's really acute moves in either inflation or in growth, and particularly in growth, there really is no urgency. Central banks don't move very fast at all, unless they basically need to move fast because they're seeing indications of that. And that's essentially what we've seen with this Federal Reserve, which is, they basically said inflation's a little too high. Given that inflation's a little too high and the economy's pretty strong, like, there isn't any motivation to do much. Will they do one perfunctory cut or something like that this year? Who knows? Like, maybe, maybe not. It also doesn't matter. It's not a very interesting trade or has much impact on the economy if you cut one time or something like that. But odds are, like, given the economic trajectory and the fact that inflation remains a little too high and there's no acute slowdown in economic conditions or rise in unemployment, yeah, the natural state for the Fed is simply to collect more information, because collecting more information always sounds prudent relative to acting.
Yeah, no, I think that's smart. So let me ask you this. You had mentioned that gold and commodities certainly did well in the 70s, which were, self-evident. But do you think that's going to be the trade moving forward? Do you think that naturally gold and commodities should do well in this kind of environment?
I think part of the story, particularly when you think about extractive commodities, and I'll leave oil aside because I think it has its own idiosyncratic supply demand elements. But if you think about the sort of broad set of extractive commodities, you had basically 15 years of depressed prices. And the way these commodities work is that production that you see in the market today is a function of investment decisions that were made 15 years ago. And so as a result, we've basically had 15 years of underinvestment in these commodities because prices were low. And it doesn't take, and because of the elasticity, because people are not particularly price sensitive in these commodities, because they're like, a very small element of an overall price of something, that sort of low supply has been decaying over time, at a time when, stronger global economic conditions are picking up. The economy is not necessarily booming, but it is certainly stronger global economy, stronger than where we were post GFC. And so that creates sows the seeds for sort of a traditional commodity super cycle type dynamic. Now we're seeing that play out. CRB, which is a diversified commodity index, not overweight to oil or metals or anything like that. That index is now, has been up the last couple of years. It's pushing to new highs. It's at 12, 13-year highs. And there's a lot of dynamics in place for that to persist. So that's the sort of dynamic that's happening in there. And you add on top of the possibility, let's just say the possibility of increased global conflict, which is particularly and acutely beneficial to commodities. Whether or not, you think it's a good idea or not, it certainly is beneficial to commodities, because what you're doing is you're basically using commodities and destroying them. in that process. And so that's another sort of tailwind that exists in commodity prices. And so I think it's a good reason to believe that the commodity infrastructure, a balanced portfolio of commodities, is likely to do pretty well on a forward-looking basis. It's certainly something you want to have in your portfolio, because if commodities are doing well, that's inflationary, and that will be a drag on things like bonds, which are your typical diversifier.
So yeah, and that's good because I know they used to have this thing called stocks, bonds, and commodities. Of course, we don't talk about that anymore. People have forgotten about that.
Yeah, that's that marks your experience in the asset management business when
Yes.
when you start talking about that.
Yeah, yeah. That was at the tail. That was the tail end of that when I got started in '99 when they no longer allowed you to trade commodities in the brokers, but there was still one person in that in that branch that was allowed to trade them. But before that, they required everybody to get a Series 3, and now it's like, oh, that's too much risk. We get away from that. um. So 2 points. So one is you'd mentioned global conflict. What black swans do you see out there that are potential issues that people should be thinking about or at least prepared for?
Well, I think for most investors, their portfolios are quite unprepared for a wartime environment. Now, do I think that I'm not sure this is even a black swan. It's not, it wouldn't be shocking that we enter a period of increased conflict. If anything, what we have experienced over most of our professional lives or personal lives is unusual, like one quarter, the sort of global conflict that has existed for the last, 500 years. And so, could we be entering an age where there is increased global conflict, de-globalization, et cetera? Like, I think most portfolios are not protected from that because they're not well protected from the rising inflationary pressures and rising commodity price pressures that would come with that. Not to mention the expansion of risk premiums and things like equities that would inevitably come, or the elevation of bond yields relative to conditions in that sort of environment because of higher inflation, and also because you have increased deficits would inevitably occur during that circumstance. And so I think if you're building a long-term savings portfolio, that sort of dynamic has to be a consideration in your portfolio today. I think that's kind of the biggest unconsidered topic that most people just aren't wrestling with.
Okay. All right, good. So what are some, I know commodity complex has been interesting. I know coal, it was a coal ETF, and at the very bottom of the coal price market, they closed it, and now you couldn't invest in coal after that. But that seems to be a trend where things kind of go away, and then it's a great time to invest. What are some simple ways that people can invest in the right type of commodities for, for this changing kind of macro environment that people are unprepared for?
Yeah, there's a lot of great ETFs in the market that are available, diversified ETFs that are low cost. So you might have something like, the BCI ETF, which is just, mimics an equivalent to the CRB, a very diverse commodity basket, which is very low cost, and they're not quite as tax efficient as most ETFs, but they're still more tax efficient than going out and doing it yourself. And then for gold, there's obviously a lot of very low cost ETFs that are out there in the market that are very efficient. So, there's GLD, which is slightly higher cost, or IAU, which is lower cost. These are all these assets are very large, liquid, available on every platform, very cheap to transact in, and most importantly, they're liquid, right? You don't have to do something unusual and sophisticated to get exposure to this. Like, you can get basically what you need, with a click of a button. The same way you buy SPY, you can buy commodity exposure or gold exposure.
Now, I know sometimes with certain ETFs you can get K1s, which of course people don't like. Our I know GLD doesn't have K1s, but how do you access commodities in a reasonable way without the K1s and frankly, without investing in futures, which in itself has its own problems when
Yeah.
when you have a future-based ETF.
Yeah, there's been, if you go back like 10 or 15 years, a lot of the initial ETFs related to commodities were structured in a way that generated K1s. There's been a set of innovations that, well, we don't need to go into all the details of because it's probably pretty boring, that are what are called non-K1 generating commodity ETFs. So as a simple example, like BCI is a K1 free, or is promoted as a K1 free ETF, so you don't have to deal with that. And there's a few others. I just mentioned BCI. I mentioned BCI not because I have any financial interest in it. It's not my product, and not I'm not associated with it at all. It's a good liquid, relatively inexpensive product that gets the job done the way SPY or GLD might.
Okay, cool. So as we kind of wrap it up here, what are some final thoughts you think our listeners should be aware of in the global macro space, or just things that we haven't discussed you think are kind of interesting?
Yeah, I think probably the biggest thing for most investors and really most savers is that prudent asset management will always underperform the shiniest thing that people are talking about. And the challenge, it seems obvious what the shiny thing, today it's Nvidia, before it was Bitcoin, before it was, something else. It always seems obvious what the shiny thing is. But the reality is most people are talking about what was the shiny thing and not what will be. And most people cannot predict what will transpire in the future. And so chasing, chasing those returns, you're much more likely to underperform ahead rather than outperform ahead if you're chasing that. And so the power, what it feels like, the power and the pressure to go chase is strong. But if what you're trying to do is build wealth over time in a savings portfolio, what that means is you will always underperform the shiniest thing being talked about. And that's okay, because it means over time you are going to compound wealth, build wealth, and outperform over the long term. Maybe not in the short term, but over the long term. And so it's very, it's a hard thing, when everyone's at the golf club talking about how they're, making so much money on Nvidia or whatever, or this or that, you feel silly. But that reverses, and what will work out over time is prudence. And so that's in some ways the boring but real way of how you build wealth over time.
And I can't believe this didn't come up, but what are your thoughts on AI? What do you think that's how that's impacting? I mean, just from an investment standpoint.
Yeah, I mean, as a simple example, our technology uses an area of artificial intelligence, and we were working on it before it was cool, so to speak. The impactfulness of AI is still uncertain. Techno optimists will sort of say it's absolutely certain we're going to have 2% GDP growth, incremental GDP growth as a result. That is, those sorts of expectations likely need to be tempered. The size that we're talking about on a global economic scale, we're talking about like $100 billion of investment on a $100 trillion global economy related to this. So it's not hugely moving the needle. We have yet to see improvements in productivity associated with it, which raises questions about whether it really is as revolutionary as people might expect. At an economy-wide level, we're seeing productivity actually flatten in the US, UK, and Europe, and Japan. And so all of that points to temperance, being tempered about what the likely impact is. I mean, the reality, as a person who's been in the sort of systematic investing space for a long time, like, tools come and they keep evolving, they keep getting better. And if you've seen a lot of these stepwise, you've seen a lot of these functions through time over 20 or 30 years, this, first of all, AI has existed for something like 60 years, but this looks, modest in terms of its incremental impact uh, on overall productivity. It doesn't look revolutionary the way, for instance, things like the personal computer, um, you know, did years and years ago, or the invention of the resistor, or indoor plumbing. And it's just important to keep that in mind when you're thinking about what could be the productivity impact. Like, indoor plumbing was a much bigger deal, or electricity. Those were things that added, a point or two to real GDP growth over, a multi-decade time frame. Like, is Chat GPT going to do that? Like, yeah, probably not. Would be my guess.
Yeah, I would agree. I think indoor plumbing is much more important than ChatGPT. Well, Bob, I really appreciate you coming on the show and sharing your wisdom with us. This has been great. Where can people find more about you, and tell us a little bit about your ETFs?
Yeah, if you want to learn more about uh, sort of day job building, making 2 and 20 strategies available for everyone at a much lower cost, unlimitedfunds.com is our advisor site. Definitely go check that out. It's got links to our products and things like that. And if if you found this somewhat interesting around the macro dynamics that are at play, I run a pretty active Twitter at Bobby Unlimited. Or you can also find me on YouTube under Bobby Unlimited as well, where I've got various clips, as well as a totally free monthly macro outlook that I do as well.
Awesome. Well, Bob, really appreciate you sharing your wisdom with us. This has been great. We'll definitely have you back on in the future. The global macro environment's never going to stop changing, so we could always use your insights. So thanks again for joining us, Bob.
Thanks so much for having me. Really enjoyed it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Bob. Really appreciate him coming on the show. Now we're into the panel portion of the show. We have our very own Barb Freeberg. Hey, Barb.
Hi, excited to talk about Bob Elliott's thoughts today.
Yeah, glad to have you. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, good to be here. Looking forward to a good conversation.
Awesome. Well, looking forward to it as well. All right, Barb. So what were some of your takeaways from the interview?
Well, I loved his topics on chasing returns because I think we all experience some FOMO when we see the highest returns that the certain asset classes get. And we think, well, my portfolio didn't get that. Shouldn't I have owned more of that? Why aren't I in more tech stocks? Or why didn't I buy Bitcoin when it was $14,000 for one Bitcoin? So we all experience that. But he helped reframe the concept that a balanced portfolio over the long term is really going to give you overall better performance, and you really have to keep your FOMO in check. So I'd like to delve into that because it really hit me very strongly.
Okay, cool. So Phil, what about you? What are some of your takeaways?
I agree with the idea of not chasing returns, and I'm going to take that when we get to that longer discussion. I'm going to take it in a little bit different direction too. But FOMO and chasing returns are things that we all suffer from, and anything that we can do to avoid those things is really going to leave us better off. That was the main thing. I thought what he does is interesting. It can give you access to an investment that many of us can't get. I just don't know enough about how the fee structure actually works to understand how cost effective it really is.
Okay, cool. So yeah, so Barb, it's funny. Ever since I started in this business, people were Wall Street was promoting hedge funds. I remember there was a big 100-page report that UBS had put out about hedge funds, and I was fascinated because I didn't know what they were. It was like my first year in the business. I was like, oh, this is a really cool idea, and they pitched this idea, and then years later, hedge funds were becoming cool. Like, hey, I have access to a hedge fund. What are you in? And this whole FOMO and, mine is bigger than yours kind of a thing. And it's like, look, are hedge funds a good idea or not? What are your thoughts, Barb? Do people need hedge funds in their portfolio?
No. And first of all, look at the fee structure. The 2 and 20 means that you pay a 2% fee for to invest on the amount that you have invested into the fund up to a certain point. And after that point, then 20% of that profit goes to the hedge fund manager. I don't know about you, but my S&P 500 ETF charges less than 5 basis points. And so if you put the net returns side to side of investing in a diversified portfolio over the long term of a US and an international stock portfolio next to the returns of 90% of hedge funds, their net returns to the investor. And actually, Bob Elliott also said this. You're going to come ahead with the index funds. So for regular investors, even if you have enough money to get into them, they don't make sense. They just financially don't make sense. Yeah, there are a handful of them where the investor comes out ahead, but the risk is so great that I just don't get it. That's like trying to find, a pearl at the bottom of the ocean. Yeah, you might be able to find it if you found the right oyster, but how long is it going to take you?
Doesn't stop people from hunting for oysters, Barb. All right. So, Phil, what about you? What are your thoughts on hedge funds? Are they worth it?
I would say no also, and the fee structure is the main reason. I mean, there are some that are probably worth it because they get really good returns, but the problem is that for the most part, those ones that get the really good returns, they've been around for a long time. They're not accepting new investors. So your access to the ones that have the good track record is not easy to obtain. And talked about the 2 and 20. It goes beyond that because since the hedge fund manager knows that they also have like these hurdle rates in them, and if they start to lose money, then the hedge fund manager will often shut down the fund and start a new one. Why? Because they've got losses and they have to get over those losses before they can get their 20% profits again. So they'll shut it down and start something new. So you're really not in a great spot if you're an investor, because now you suffered these losses, and then the next guy steps in, and now those losses don't factor in anymore if you start new. So they're expensive. You can do better the vast majority of the time by just investing in a simple S&P 500 index fund for a lot less cost. Costs really matter when it comes to investing. So if costs really matter, why would I want to do something that locks me into paying 2% of my assets plus 20% of the gains that the fund makes over a certain, over a certain income level? I just don't understand why I would want to do that. You have to be an accredited investor to invest in hedge funds, but the rules, to put it mildly, for accredited investors don't really mean you have a lot of extra knowledge, because they're usually based upon like what your assets are and things like that, not really your knowledge. So it's an easy way to get sucked in. Just because we have a lot of money doesn't mean that we make the best choices with our money all the time. So we can hear great stories about people that are doing well because they have some, but you don't hear about all the people that aren't, right? There's a lot of FOMO in the world. That's an example of one.
Yeah, I'm gonna be the contrarian here. You guys are too easy. So I'll just say I'm in favor of hedge funds in certain ways, and I'm not disagreeing with what both of you said, but I want to point some other things out. So I think hedge funds kind of fall in the 95-5 rule. It's like the 80-20, but it's actually more like 95-5, where 95% of the hedge funds are mediocre, and then there's 5% that are stellar, and everyone wants those, and they're not accepting new money, just like what you guys have said. If you're paying 2 and 20, the fees, totally get it. But I don't look at fees. Everyone gets caught up in the fees of hedge funds. And, all else being equal, I agree. But hedge funds are not equal. That's not the point of a hedge fund. The point of a hedge fund is diversification. So if you are investing in the S&P, yeah, you can get a better return in the S&P, but that's not the goal of diversification. The goal of diversification is to not get the same return as the S&P. It's to improve your risk-reward trade-off. So for hedge funds, for example, the goal of a hedge fund, and by the way, there are many different types, so it's not like there's a single one. It's not like the S&P. Some are long short, some are international, some are delta neutral. Like there's so many different types out there that it's really hard to just say hedge fund, because it's like saying a stock. Well, there's lots of different stocks out there. Or saying an investment. It's like, well, there's different types of investments. So calling it a hedge fund is kind of like saying it's a stock. It's a broad asset class, to say in air quotes, which the intention is to get more absolute returns. Generally speaking, most of them shoot for absolute returns, which means that good times, you should make money. Bad times, you should make money, or at worst, not lose money. That's really the goal of a hedge fund. And in general, like everyone's different. Some of them are delta neutral, which is their job is to pick stocks better than everybody else, and they're taking the market volatility out of the equation. So, if you are in a hedge fund, you shouldn't experience the same volatility. If you do, you're in the wrong hedge fund, right? So like a delta neutral is basically, it would be like buying Walmart and selling Costco, right? It's same industry but different stocks, right? So you're assuming one's going to do better than the other. So it doesn't matter if the market goes up or down, because one's going to offset the other. What you're doing is you're getting the spread of the difference between one and the other. So there's a lot of delta neutral out there. So I totally agree with everything Barb and Phil said, but I will point out that there is a purpose for them in a portfolio, which is you're trying to lessen the volatility, if that's your goal. If you're trying to find non-correlated returns or low correlated returns, hedge funds can be a great way to do that. Now, you might not like the outcome, because that might mean you're not getting, 5,000% by investing in NVIDIA, but it might also mean that you don't lose half your stuff in 2008 because you invested in the stock market. So, it should swing both ways. Realistically, if you're looking at a hedge fund, you should be looking at what is the absolute goal of what they're trying to do, right? And are they meeting it? And if they are, then it's doing a good job, right? So institutions invest in hedge funds because they're trying to accomplish a very specific thing. It's like a little sleeve in the institution. It's like, oh, I'm trying to get an absolute 6% a year. Like some of them will have a target number. We're trying to hit 6 to 8% a year. That's it. And obviously that's what they're trying to do. So the market goes up 30, they're not trying to get 30. The market goes down 30, they're not trying to get down 30. They're trying to get 6 to 8. So I think the real way to look at hedge funds is, are they accomplishing the goal that they've set out for themselves? If they are, and you're happy with it, then it's a good investment. But you can't look at a hedge fund and say, well, it's not performing like the S&P, because that may not be their goal. So I just point that out because everyone looks at things in absolute terms and they look at things in terms of S&P index returns, and that may not be what you're shooting for. Because if you want that, just take all your money, put all your chips on the S&P and take a risk. I'm not saying to do that, but if that's your goal, then that's the best way. Hedge fund's not the best way to do that. So just understand what you're getting yourself into. Barb, I do want to talk about chasing returns because obviously that's a big factor in what investors try to do. Hedge funds are a way to do that. Now people are putting it, then people after hedge funds, they want to put their money in managed futures. That lasts about 3 or 4 years. They want to do private equity or venture capital. Right now it's private equity. Everybody wants private equity. Why can I get my private equity? It's like, should you really? Should people be chasing returns, or how should they be thinking about these different asset classes?
Well, valuations matter. And how we look at valuations is sometimes it's a discounted cash flow model. Sometimes we use a price earnings ratio. But in general, you want to look at what is the intrinsic value of the asset you are investing in. And really an easy way to do that, at least with stocks, is you can get that figure, I believe, on Yahoo Finance and also on Morningstar. And right now we are in a period where the stock market is very much overvalued because we have, face it, since 2008, the stock market has really soared. And the tech stocks have gone through the roof, some of them more so than others. And so many investors are feeling giddy and thinking that these past returns are going to continue into the future. And so this is a real, I think, inflection point, or a really important point to say to yourself, wait a minute, if I'm looking at the returns of NVIDIA or the top 7 tech stocks, and I'm saying, I didn't get those, what am I doing wrong? I better buy a tech fund, or I better invest in those companies now. I would say don't listen to those type of instincts, because in general, if you are investing for your life, from the time you're 25 to 65 to 80, whatever, your goal is to have enough money, during your life and when you retire, so that you can fund the experiences in life that you want. Your goal is not some ephemeral thing of, I want to be the absolute highest return investor ever, because that's impossible. And so we all need to take a step back and say, yeah, there are some like super high returns, but whenever you get those really high returns, there's always a period where those type of returns stop. And then you find that there are, reverse conditions where returns really, really decline on some of these very speculative, high returning assets. So in general, you want to avoid chasing returns because, first of all, most of the time you're going to time it wrong. And if you start plowing all your money into NVIDIA now, or the highest tech stocks, which are overvalued now, you're more likely to lose money going forward than to gain money, just because these type of assets are very, very overvalued above their intrinsic value today. So the alternative, really quickly, is to be satisfied with a reasonable return that your portfolio is more likely to maintain throughout your life. And if you mix up stocks and bonds throughout your life in varying percentages, maybe throw in some other assets in a small percent, you can hope to get maybe an 8% average return. Now, is that 15? Is that 20 over your life? No, But what it is enough for most of us to reach our financial goals and also not to suffer catastrophic 50 to 75% losses when the market corrects.
Yeah, no, I appreciate that, Barb. So Phil, I had a question for you. In chasing returns, I know people have been talking about commodities for a while. We have, but they've kind of soured lately. I mean, you have kind of a background in energy for sure, and probably familiar with some other commodities. What's kind of your take on commodities right now? I mean, people chasing returns, or what are your feelings about that?
So you're right. I mean, oil is the one that I know the best, right? Because I covered that industry. I'm not a big fan of commodities. Sometimes I'll put a small allocation. Most of the time I don't, because I have a tough time, to get back to the valuation question, I have a tough time valuing them because I I don't know. I just don't know for sure what they're worth. They don't provide any return. I know that they're needed, and you can look at things going on, and there's certain precious metals that are doing well right now, but they have their ups and downs. To me, when I can't value an asset, even though I know that whatever valuation I say, it may not be absolutely correct. Hopefully it's directionally correct. That's really what you're shooting for when you're doing valuations, to be directionally right, because you can't forecast everything that's going to happen, which is what would have to do to come up with a precise price. But because of the fact that when it comes to commodities, I have a tough time valuing them. I'm not a big fan of them. I will also tell you that if you are investing in commodities, like one of the things that I learned as an oil analyst is I want to understand what the company's cost structure is, because companies in economic terms, we have price takers and price makers. The price takers are the ones that take the price that the market gives them. And that's how most commodities businesses work. Price makers, they kind of set the price. And that's more what you would see like in the healthcare, like, pharmaceutical companies and technology companies. They can kind of set their price a lot easier. So when you're a price taker and you can't control the price that that what you're producing is sold at, your cost structure really matters. So one of the things that I always focused on as an analyst looking at it, doesn't matter if it's oil or if it's gold or if it's silver or copper or any other miner, you want to understand what their cost structure is, because if times get tough, their cost structure really matters, because that's going to give you the best indication as to how likely they are to survive, because we know what their cost is, so we can kind of get an idea of how much of a hit could that commodity price take. Because if I go back to 2008, I remember when oil prices, they went all the way up to $147 a barrel. And within a few months, they were in the 30s. Nobody predicted that. Nobody. Right? But if you knew what the cost structure was, at least you knew the companies with a better cost structure aren't hurt as much in that type of environment.
Yeah, it's a great way to look at it. I think one of the challenges of commodities is they're definitely tied to inflation, and we had a bout of that, and then the inflation kind of went away, and so maybe we've gotten to this place of low inflation, and maybe that's just the nature of things now due to the large amount of debt out there. Um, but it's very curious because it doesn't apply to all commodities. Like cocoa prices went through the roof, and they're still high. You got precious metals, which have been doing well. So it's just commodities are an interesting space, and I think investing in commodities is really hard. There are times you want to be a bull, there are times you want to be a bear, and there's times you want to be a pig. But if you don't invest in good companies, if you're investing in the company space, if you're not investing in good companies, you can really get yourself into trouble. So as we kind of wrap it up here, Barb, final thoughts from you.
It's the tried and true method of long-term investing. Remain diversified. Don't look at your portfolio every day. Invest for the long term and start when you're young. Invest in your 401k, an IRA, a brokerage account, put a set amount in every month in a diversified portfolio of predominantly stock funds, lesser bond funds when you're younger. And over the long term, you're going to have enough wealth to meet your goals. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and also on YouTube.
Great. Thanks for coming on, Barb. And Phil, final thoughts from you.
So I agree with everything that Barb just said, but I'm going to also add one other thing that can happen when we chase returns. If we chase returns, think about it. What are you going to do if you get the best returns? Are you going to be able to use that money? Are you going to be able to do anything with it? Because like a lot of people that build these really big portfolios when they get to retirement and they're afraid to spend. So also don't be afraid to use your money to have experiences, to do things that matters to you. I was on a call with some other advisors earlier today, and one of the guys had this concept that I really loved. He talked about the fact that what sits in your portfolio is unrealized wealth. And if you don't use that money, it just sits there and it's unrealized and you never got to benefit from it. So while you're thinking about diversifying and having these long-term returns, remember along the way, it's okay to do some things, and it doesn't all have to be for a future that you might not ever achieve. My mother passed away at 53. She didn't get to do all those things. So even if you are saving, you might not get to achieve it. So don't be afraid to take some of that money and use it. Take advantage of that unrealized wealth that sits in your account. As for me, I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook, and you can also sign up for our blog. Thanks for having me today, Kirk.
Yeah, thanks for coming on, Phil. And I totally agree. I think people should be using their wealth and not wait forever. Unless, of course, you bought that Bitcoin pizza about 15 years ago and you paid 500 Bitcoins for that pizza. You might not be enjoying life the way you think you are. So just saying. Anyway, all right. We had some fun today. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.